All right, well, one of the next key tests for the market rally is the Fed's preferred inflation gauge. That's PCE. It's out later this week on Wednesday. Last week, Fed Governor Michelle Bowman expressing concern that the path towards the FOMC's 2% target has stalled after core CPI and PPI both showed that prices remain a bit sticky. We want to bring in our next guest, who says that President-elect Donald Trump's proposed policies could potentially cause inflation to rise, making it likely that we're closer to the end of the Fed's rate cutting cycle. Let's talk about him and ask him what he thinks. It's Jim Smigiel. He is the Chief Investment Officer at SEI. So Jim, why do you think that?
Well, I think it's a few things. Trump's policies certainly are pro-growth. We know that. They could also be pro-inflation. But as you talked about this morning, some of the tails of that kind of tariff distribution is kind of being priced out of the market today with some pretty smart picks, including Scott being announced on late on Friday. But it's also the backdrop that we're kind of concerned about, which is, look, we have a very, very robust economy. We have a robust economy where the Fed is still adding monetary stimulus to that. And that, in our minds, is a bit of a kind of approaching a bit of a policy error from Fed policymakers themselves. But that could certainly result in inflation catching another bid here. We see inflation expectations last week at the highest levels in quite some time. We're going to get some readings on that. That's what all eyes are going to be focused on before we break for a holiday season. But that's something that we definitely have our eyes squarely on. And the market's reaction this morning, particularly from the 10-year back down to 230, that's a move that we would fade. We would expect that to kind of revisit some levels that we've seen kind of post-Fed cut, getting back closer to that 4.5 and perhaps even upwards of 4 3/4 in the first quarter of 2025.
In terms of equities, what do you think about the sort of tempered Bessent relief rally that we've seen? What does that tell you about where we're heading into year end and kind of the market reaction to these policy or personnel picks from Trump?
Yeah, I think we're in reflation. Like, we like risk assets here. We expect that to continue through the end of the year into the first quarter. And as I mentioned, the one thing that we're looking at that's still casting a bit of a long shadow is the level of rates, right? So as we get closer to 4 3/4, that's the one aspect that could pour some cold water, we think, on this risk rally. But between now and then, we think we're in reflation mode. We mentioned small caps earlier today. We like small caps. We like value. We like financials. We think we're in for a nice rally into year end and to have that continue in 2025.
Are we then set up, you mentioned the fact that we could see this tick higher in yields once again. If we do see a bit of cold water, to put it in your words, poured on this equity rally, what does that look like? Are we talking 5% pullback? Are we talking 10% correction? I guess, how should investors be thinking about that risk?
Yeah, I think the last time that we were here, it was that 5% level that really gave the markets a bit of the jitters, and we had that nice kind of pullback in 2023. This time around, it's probably a little lower. We think the tolerance is going to be closer to 4 3/4. So if you do see that 4 3/4, that's when we would start kind of looking to perhaps diversify away, take some more defensive positions, take a little beta off the table if that's something that you've been adding more recently. Broadly, staying diversified, that's the one aspect of this relief rally that we think makes a lot of sense for end investors, to make sure that they're broadening out their risk exposures. This is not going to be a Mag 7-led, highly concentrated rally. So it's a good opportunity for investors to add to small caps, to add to value, even to add to active management. This is something that we've been trumpeting for quite some time now, using that word sort of with dual meaning. But we do like active management here. We think the passive investor is highly, highly concentrated, particularly in the United States, highly geared toward growth, obviously with the dominance of the tech sector. With the idea of broadening that out, active management is a great way of doing that as well.
Small caps have been volatile following the election, and you mentioned that we're in reflation mode right now. If we do get higher for longer off the back of that, what does that do to the small caps trade?
It's a great question. This is one I think that a lot of investors are somewhat confused about. Normally you would say to yourselves, geez, higher rates, bad for small cap. They're typically more debt reliant, and we don't disagree with that. That tends to be very, very true. If we look at what's been going on in the fixed income markets, however, there's been a lot of terming out of debt. So that maturity wall that maybe we were concerned about and maybe some others were concerned about in 2025, that really has now become a bit more of a 2026 story. So we do see a bit of runway here for small cap, even if we do believe that interest rates will be inching higher. We see a green light for small cap until, again, we get to that kind of little bit of a level above 475, which gives us a little bit of pause.